Hi, I'm Nick Spicer and welcome to this Portfolio Metrics Quarterly Update. The third quarter of 2019 was a volatile one, with a minor sell-off in August. Over the quarter as a whole, though, markets did rise. The catalyst for the sell-off in August was a breakdown in US-China trade negotiations, although the announcement that these were back on, as well as central bank easing, did lead to a rise in equities for the quarter as a whole, which were up 3.8% for developed markets in sterling terms. The quarter also saw further compression in global bond yields, as fixed income investors reacted to global growth uncertainty, as well as central bank easing and lowering of global interest rates. Global bonds, investment grade bonds, were up 2.2% over the quarter. The pound weakened against the dollar, driven less by weakness of the pound than by general strength of the dollar, which benefited from its flight to safety characteristics as investors worried over global growth and tariffs. The pound strengthened slightly against the euro over the quarter. Global developed equities were up 3.8% in sterling terms over the quarter, which brings their total return to 21.5% year to date. The FTSE 100 was up 1% over the quarter, bringing its total return to 14.3% over the year as a whole. Global emerging markets were down 1.1% in sterling terms over the quarter, giving them a 9.4% return year to date, whilst global investment grade bonds were up 2.2% over the quarter, giving them a total return of 7.4% year to date. Looking at portfolio metrics performance, Select 4, our mid-risk portfolio, was up 0.5% net of all investment fees over the quarter, and 10% year to date. Select 7, our highest risk portfolio, was up 0.1% net of all investment fees over the quarter, and 13.8% year to date. Looking forward, low global bond yields clearly indicate the market is worried about the chances of another global recession. Politics is the key risk here, as it affects the chances of a US-China trade deal being signed, as well as flare-ups in the Middle East. That said, other potential causes of a recession are not present. Global central banks are lowering rates rather than raising them. Inflation hasn't reared its head, and there are no signs of overconsumption or overinvestment. We still think, if politics keeps under control, that the chances are we'll see a slowdown rather than an outright recession. More locally, Brexit uncertainties remain high, but we do think the chances of a no-deal Brexit on the 31st of October has decreased slightly, given that Parliament has passed a law against it. That said, expect turbulence in the near future, and probably a general election. Portfolios continue to hold both domestic and international assets as a hedge against any possible outcome. More widely, portfolios also are focused more towards cheaper assets with greater value, but also with a key focus on diversification as a protection against the unexpected. Thanks for listening to this update, and here's a successful last quarter.